You will not create wealth, you will not make profit, you will not generate profits just by buying a good, sound, fundamentally strong company. Yes, you heard it right. From the previous 4 videos, we've been understanding about ratios, various ratios, interpreting them. And of course, you don't need to calculate all those ratios. It is available on major finance websites. Even your broker can give you. There is a platform called Scanex, which we're going to talk in the next video. So let's not discuss that. But just finding a good fundamental company with a good EPS, with a low debt to equity ratio, with all this blah blah blah, it will not make wealth for you. To create wealth, to generate profit, to maximize your return, it is very important that you enter into the stock at the right price. Entering at the right price is as important as finding any other company. And for that, we can understand about P ratio. It's a very, very important ratio. Um, might be this video can be small, but I want to dedicate one special video to this particular ratio because this is a base of your wealth creation as far as share market, stock market is concerned. So there are three fundamental pillars of wealth creation. How to create wealth? You got to follow these three pillars to create wealth, especially from the stock market by equity investing. Number one is you need to invest in a fundamentally strong company. Never ever invest in a company where earnings are negative, EPS is negative, ROC is not up to the mark. We've calculated return on capital employed ratio where debt equity ratio is too high. So now why am I discussing this? Because you can understand, you can correlate like whatever we have learned in past 4 videos make a lot of sense in actual life when you go into the equity investing. So if ROC is ideally less than 15, skip that company. If debt equity ratio is about 20-25%, that company should be out of your list. You cannot invest in a levered company because I've explained the reason for that when I was explaining debt equity ratio. So finding a fundamentally strong company is very essential, and that's the first vital step. If some company is not fundamentally strong, we don't even think about investing or we don't think about at what price to enter because we are not going to enter, right? So finding a fundamentally strong company. Second thing, at the right price. This is the most part. Finding a good company, important. Entering at a right level, even more important. Because there could be a good company, sound company, strong company, with a vision, with a mission. It has got a future. A few videos back, we were understanding about the mega trend, right? That industry should be in a trend. Trend is also there. But if the company share price is already skyrocketed, if it is shoot up and then you enter, you will not create that multi-beggar wealth that you could have created by entering into the right price. If you agree with me, just give me agree in the chat box, my dear. And the third, even more important, is riding that. So you got a good company, you entered at the right price, you got to ride that move as long as that company is giving you profit. Many times when I meet with traders and investors, they tell me like, Amit, I invested 2 lakh rupees in a company. In just 1 month, I got 20,000 rupees, 10% return. Oh my God, I exited. My dear, you are wrong. You probably you haven't seen the world what kind of money equity can make if you get in the right company. I have seen, I have seen in front of my, in fact, recently when I'm recording this video, I'll not name the company because that may break the SEBI rules. One company share, which was as low as 1 rupee, it jumped up to 120 rupee, man. You're talking about 10% return. Hello. 1 rupee share jumped to 120. I am talking about 1200% return, man. and that also in just few months. Okay? And this is not just one example. The companies after companies, we have seen like 300, 400 rupee share went to 3,000 in just few months. So 300 rupee share, if it goes up to 3,000 in few months, that is 900% return. Man, what are you talking about? Hello, you are happy with 10, 20%? Okay? So be patient. Market is going to give you a lot. So you got to ride the move. And we're going to talk about that. For this specifically part, we will use technical analysis. Like we will use moving averages, we will use some other indicators to ride the move. And we're going to learn that in this particular series as well. Be excited for that. If you are super excited, just type in super excited in the chat box, please. Right? So, again, price earning ratio, one of my favorite ratio because it really decides where how much wealth you will make. Formula is current market price, that is price E. P ratio नाम इस तरह से पढ़ा है, price upon earning. Earning stands for EPS. So if one company's share price is 1200 rupees, EPS is 120, that gives me 12 times, and that gives me 10 times. That means whatever company is earning, and the market is ready to give 10 times of that value, 10 times of that earnings is a value to the company, because market perceives that this is what company will be easily able to make. Okay, finding a strong company with a low multiple, with a lower multiple, is a skill, is an art. You can do it with the help of scanners. You don't need to spend hours and hours. Tomorrow in the next video, we're going to talk about that. We're going to talk about the tools which will help you to get all that. So next video is definitely going to be about tools. But this is very important. P ratio. It indicates how much value the market is ready to give to any particular company. And typically finding undervalued companies where wealth actually happens. This is what I've been emphasizing since the beginning of video. Then finding an undervalued company will only make wealth. Otherwise, you can't make wealth. It is very simple, right? And buying even fundamentally strong companies with higher valuations, will not create wealth. Just because one company is fundamentally very sound, you invest into that, yeah, you will create wealth. You will get a hefty dividend, you will get a good dividend. If company doesn't pay good dividend, the share prices will go up according to the earnings, but that will be from 100 to 120. Still, you might be very happy that Amit, I got 20% return. But if you want to get your hands onto those multi-beggars, you got to understand P ratio, and you got to focus on those companies where P multiple are low compared to its competitors. We have seen sector and subsector analysis. So if you get a company, you get a sector which is going to boom in the next decade, go into that company, go into that sector, find out the company which has got a low multiple, and if that company has got a strong fundamental, invest into that particular company. It will 9 out of 10 times it will create wealth for you, and not only just wealth, it will create exponential wealth for you, right? So that's it for this particular video. I hope you got a lot of value. Do let me know in the chat box, do let me know in the comment box. This is my favorite video. You can see from my energy as well. This is my favorite ratio, favorite video. Do let me know in the comment box that what is your learning from this particular video. See you in the next one. Thank you so much.